Hi everyone, today let's talk about Fundrise. It's that time of year again. They published their 2021 year-end review letter, so let's take a look at what that says. And then of course we'll take a look at what my actual returns were versus what they said they were. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this as well as individual stock reviews every single week, so make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So taking a look at this letter here, they say this year was remarkable. They say they received more investors this year than they have in any year previously, continuing their trend of parabolic growth. They say by nearly every measure, this was an extremely good year. And of course, we already talked about Q3, which was the best quarter this year, with the average return for most investors somewhere around 23% for the whole year. And then they show the average returns by investment plan, with the income plan receiving almost 19%, with almost 5% dividends, which is really strong. Obviously, that's the focus of the income fund. And then it goes the opposite direction as you get closer to growth. So balanced was at 3.7%, and growth was almost at 3%. But of course, the appreciation is what you're getting as you go further out in your time horizon. You get this higher appreciation, generating higher returns this year. I'm not sure if that will always be the case, but from an income perspective, obviously the higher dividends come in the income plan. They also say here that all return figures are net fees, meaning that this is the actual return. They say they launched their flagship fund, which is the Fundrise Interval Fund, in January, and within only 6 months it had grown to one of the 25 largest interval funds in the United States, with a market return of over 40% for its clients. Obviously that is a massive number, and if that continues, this fund is going to grow at a massive clip as soon as this kind of information gets out to the larger public. I do mention that this is time-weighted, and that the price per share is at $12.81 versus the initial $10, representing a 21% growth. I say it's worth mentioning that some properties grew 50 to 100% in a single year, and this is unsustainable. They say it's extremely rare, particularly when you consider the low amount of leverage, and in their opinion, it's not going to continue forever. Again, this doesn't mean they don't expect strong growth and strong performance, but of course, that kind of return is not necessarily going to happen all the time, and in their opinion is extremely rare. So what's been driving their performance this year? They say they've gone over a lot of the aspects that have driven their investing strategy here over the past couple years, and they do talk about that deeply in their first podcast, Onward, which you should definitely check out if you're more curious about their investing strategy. But here they're focused on the structural nature of their investing strategy or their investment model, which is also very important. Unique to Fundrise in this perspective is their competitive advantage of how they raise capital and how they can invest across the entire geography of the United States and deciding on which properties to choose to generate the highest returns. Say part of this reason may be less obvious, but they appreciate the benefits of investing in real estate, where they have some insider knowledge generally on how the real estate investment industry is doing, which generally puts the individual investor at a disadvantage, but really benefits Fundrise, which is the medium that Fundrise creates. It allows you to invest in these private real estate markets, which investing in publicly traded markets, ETFs or REITs, just doesn't give you the same opportunities. And they start to talk about where they think they are in terms of the general growth trend, and they think they've completed the early stage, and they're working through the growth stage, and then at some point, hopefully, they'll become a publicly traded entity, and I'll be able to sell my IPO shares that I purchased internally. I say much like investing in Google, Facebook, or Amazon, in the early stages, that was restricted to private capital, much like some of their real estate that they invest in was also previously restricted. And even if you did have access, you had to go through intermediaries or gatekeepers who all charge high fees and sales commissions, which eat into your profits. In fact, if you don't have a pension, most investors can't invest in these at all. If you invest in companies on the public market, you're often paying a premium for those highly valued assets, which generally again eats into your profits. Both of these ideas are disrupted by the private equity chain, which lies at the heart of Fundrise's investing plan, which is really the main benefit of investing with this company. They also did the same model with their IPO shares, giving investors an opportunity to own part of the platform itself. Moving forward, they say the future is always uncertain, and they've already worked through once-in-a-century black swan event, and they're looking to see how that continues to play out. They also noted the return of inflation after a 40-year decline in inflation, it has reemerged as powerful and potentially destructive force. If you've been paying attention to inflation, you've definitely noted that it's going well above 6%, and it is certainly setting some recent highs in terms of total inflationary pressure. They say it's hard to state the significant importance of the shift to an inflationary environment and the changes that could accompany it and their effects on Fundrise. Inflation can obviously eat their way through the economy, causing short-term price increases as well as difficulty in supply chains, creating a self-reinforcing cycle. Again, this is relatively common knowledge if you've been paying attention to the economic data here recently. There are supply chain shortages, which cause prices to go up, as well as there's quite a bit more money out on the market now, which are also causing significant increases in prices across the country. They say unless salaries and assets increase at an equal pace, which they rarely do, people often effectively become poorer. Most concerning to Fundrise is that when inflation goes up, interest rates also tend to go up, which does affect their ability to use debt to purchase more real estate. All forms of debt, corporate, consumer, and government, tend to become more expensive until at some point it becomes unsustainable, and then we have a wave of defaults rippling throughout the market, generally ending in some kind of recession. Despite this new and very real risk, most people don't really understand the impacts quite yet because interest rates have been falling for so long to go lower and stay low forever. But of course, this is a cyclical event, and it should have been expected that interest rates were going to rebound and head higher. We also mentioned that there's some data saying that inflation will likely reach double digits, and that creditors are lending at negative real rates, meaning they will receive less buying power back at the end of their term than what they lended out. They do mention some of the logical reasons that creditors might do this, and they potentially expect historical rates to return to their lows, meaning that they might actually make some money over the next few years. More likely, it seems like people are just not willing to accept the fact that interest rates have effectively bottomed and are potentially going to head higher. I say to be clear, it is their opinion that interest rates are going to continue higher, along with inflation, and to protect themselves from the erosion of their value. So this puts investors at a difficult spot deciding where to put their money to help combat the effect of inflation on their own individual buying power. You can pick stocks or bonds, but generally these are going to potentially return negative real returns because they would have to compete with inflation, which may be difficult for some of these companies. Fortunately, real estate is one of the few assets that tend to be both resilient in downturns and perform strongly in inflationary markets. And based on what they experienced over the last 12 months, they expect residential and industrial properties to continue to do well in this type of environment. And they go through exactly why real estate is a little bit more important than financial assets. And then they talk about why real estate is a better option versus financial assets. Because real assets have an effect on everyday life, people need their homes and places to do business, which means they tend to be more resilient versus the decreases in spending as a result of decreased purchase power. They say they've continually gravitated towards residential and industrial assets because they are both supply constrained, meaning that the demand for these has accelerated with a limited supply. They believe we're in the early stages of a $1 trillion value transfer of office and real estate assets to residential and industrial assets, primarily because of the technological revolution. Moving on, they say, stay skeptical of the consensus, meaning that the experts don't really agree with their perspective, and they're a bunch of haters and they're wrong. Moving over here to my actual performance by percentage and by fund, you can see East Coast did pretty well at 20%. All the growth REITs did really well, but Growth REIT 1 here at over 40%, Growth REIT 2 at 34%, Heartland did really well at 41%, Balanced REIT 29%, Growth REIT 3 at 47%, then we have Growth REIT 6 here, Growth REIT 7, and then Interval Fund here at 40%. So in terms of dollars, let's see what that looks like. See the Growth REITs did well here, over $800. Growth REIT 3 apparently is one of my biggest investments here at over $2,100. Then we have the Interval Fund here at $1,308, netting me $6,787 this year. And then looking at the percentages by year, you can see it's definitely going up, almost 7%, and then 24%, and then we'll see how we do this year. And then looking at dollars, again, went from $1,300 to almost $7,000, and so far this year, in the first 2 weeks, I've made $18. But I also want to mention here that once you get started with Fundrise, it does not grow extremely fast right away. I started investing in 2019, and my return for that first year was only 3.8%. Last year, almost 7%, and I was getting a little bit concerned. And then we had a massive year in 2021 at 24.3%, generating my total net returns here at 15% over the last few years. Over 3 years, this is not a great number, but you can definitely see the trend here. I think these early years are weighing down my percent growth. And if we continue to see relatively average growth for Fundrise, somewhere between 10 and 15%, making 2021 the outlier, I think this percentage will definitely go up. And of course, this is going to be compounding. As you can see, my account value started very low here in 2019. Then I bumped it up substantially to get to that $10,000 level, which gets you into that kind of intermediate level where you get offered the plus portfolios. And then I continued to add to it every single month for the last several years. And you can see where those net cash flows are right now. And then you can see here my all-time net cash flows starting at $0 in 2019, almost $21,000 here in 2020. Huge cash flows in here in 2019 because I did sell a house. So I had quite a bit of money from that sale and I wanted to reinvest it into real estate, but I wasn't buying a house immediately. So I put it here in Fundrise. And then you can see here 2020 was a little bit lower dollar value. I was trying to build my trading portfolios and stock portfolios, so I decreased my growth here. And then back in 2021, I expect this to be my more reasonable number in terms of portfolio adding. And you can see here the dollar values continue to grow pretty substantially from 2020 to 2021. And here in 2022, you can see I've already generated $18 here in the first 2 weeks, which is pretty solid. If that trend continues, definitely going to make solid returns here in 2022. If all of this makes you want to join Fundrise and for some reason you have not done it quite yet, definitely use the link. I'll put this down in the description, or you can copy this link right here into your browser. That'll save you your first 90 days worth of investor fees, and it will also help out the channel. Let me know down in the comment section what you think of Fundrise. Is this trend of growth going to continue? And will they continue to generate outsized returns for their investors? Definitely like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future content. Of course, none of this is financial advice. This is all for entertainment purposes, and have a great day.